Hey guys, Taylor the GammaEdge here coming at you with another educational piece today. What we're going to be talking about is the SPX options complex, specifically that there's two complexes, the SPXA complex, SPXP complex. Reason we're doing this is, folks new to GammaEdge are not familiar that the SPX does have two different complexes, and we specifically at GammaEdge look at these separately and distinctly because they're telling two independent and important stories. So with that, have you ever wondered why some markets fizzle out while others develop into sustained trends? The answer may lie in understanding the different segments of the SPX options market and specifically what they tell us about trader positioning. So right, as I was just saying at GammaEdge, we separate the options market complex, the SPX options market complex, into its two distinct components, SPXP and SPXA. The reason we do this is because analyzing them separately gives us a more complete picture of market sentiment and potential for market turning points. So now getting into those two distinct contracts, we're going to be using boating analogies just because it's a good way to think about it. So with that SPXA, this is your AM settled contracts. So you can think of this as like a massive cruise ship. Reason for this is because, this is kind of where large institutional, slower moving capital tends to transact. These are your monthly and your quarterly SPX expirations. And as you will see, this complex is much larger than the SPXP complex. However, the SPXP complex, you can think of that as kind of a nimble speedboat, fast, reactive, and quick to change course. Reason for that is this is your daily, this is your weekly, this is your 0 DTE contracts, and this is where your short-term traders and active speculators tend to transact. So the reason why this matters, why we separate, is because while most traders or some traders, will look at SPX in its entirety, blending the two together, when you're doing this, you could be missing some critical signs that the SPXP is separately telling us that the SPXA, when merged together, could mask, and vice versa. So let's get into that. So SPXP, you can think of this as kind of your early warning system. And specifically, the SPXP expirations typically show structural changes first. Since these contracts are dominated by short-term traders who actively manage their positions, shift in sentiment and positioning here tend to happen quicker than in the longer dated counterpart SPXA. For example, during bearish to bullish market shifts, we see puts closing and calls opening in the SPXP structure generally before that happening in the SPXA structure. The shorter expiration cycle and the nature of traders transacting within this complex versus the longer term investors of the SPXA complex means that positionings turn over faster, allowing us to detect those changes in position quicker. These changes that we're seeing in the SPXP should then trickle into the SPXA complex as well. And this confluence would give us kind of more confidence of a sustained move in that direction. And again, the reason this matters in studying SPXP separately from SPXA or the SPX in general is it helps us with identifying potential inflection points early, meaning through SPXP, we can see that shift from put speculation to call speculation or vice versa. Specific to just analyzing SPX 0 DTE, we can understand those shifts in intraday volume analysis and momentum. And again, the SPXP being the speedboat gives us an understanding of the immediate positioning and sentiment of the active trader. And right, this is critical because at GammaEdge, we cater to both, longer term investors, swing traders, as well as, short-term 0 DTE future scalpers, options traders. So the SPXP, again, is invaluable for us intraday traders, but then as well as part of our market turning framework, it's critical in understanding from a swing trading point of view when those underlying conditions are starting to get more favorable. And this brings us into SPXA, which again is our cruise ship and kind of more of that institutional confirmation. And so with that, right, SPXA is slower to move, but when it does move, as in, the structure starts to shift and change more, that does carry more weight into kind of longer term expectations. Again, just to recap, SPXA expirations represent institutional positioning where we have larger capital commitments and longer time horizons. When institutions do alter their positioning, they're making strategic decisions that have the ability to sustain moves rather than short-term speculators. Right, and just to clarify, because I thought what I just said was kind of confusing. When these institutions are making these strategic decisions and strategic changes, these changes can have lasting and sustained impacts on the market rather than, just be forms of short-term speculation. So what that means is, institutional backing provides a fuel for lasting trends, unlike the quick repositioning that we sometimes see in the SPXP complex. So SPXA and the slower moving component acts as our confirmation gauge. When SPXA and SPXP align, it suggests that the market turn has meaningful backing from the major players, increasing the odds of a lasting trend rather than just a fleeting move. And just to recap, when we see changes in SPXA, it's signaling larger players are repositioning. The move that is likely started within our market trend model and the SPXP structure now has a better chance of persisting as we start to see that change manifest in the SPXA complex. And then, that trend may have a better kind of long-term staying power. And then, to beat a dead horse here, the most powerful signals come to fruition when we have alignment between SPXP and SPXA. So SPXP, that is going to shift first. That's your early warning sign. SPXA structure confirms that directional move with institutional backing. And then, that all just comes to fruition when both are showing the same structural characteristics. So now getting to how we apply this within the GammaEdge process and kind of how you can apply this to your process. This is not confusing stuff. And just one point to clarify real quick, even if you don't trade options, I don't express my trades through options. I use futures, right? You can still use what the options market is telling us in terms of the positioning. Because a ton of transactions today take place within the options market. And the options market is inherently forward-looking. So by understanding the positioning within the options market, we can understand at a generalized level what the market expectations are. And, whether then from there, you use stock, you trade futures, you trade options, whatever it is, feel free to execute the position however you want to. But this information is critical to kind of develop your market awareness. And so getting back to SPXA, SPXP, this is a key part of our daily pre-market process. We do a kind of detailed write-up and as well as YouTube video, most, if not every pre-market morning. And, analyzing SPXA, SPXP is a critical part of that, right? It's how we get our, understanding of market sentiment and then also key levels as well that we focus on. And in our article that we wrote last week, or if you're watching this on YouTube, then within the playlist, we have a video on our market turning framework, which effectively tells us kind of where there's high probability points in the market of where we're making kind of a bearish to bullish shift or bullish to bearish shift. And and the key pillars of that are monitoring SPXP for those early warning shifts in sentiment. And we do that through our delta balance analysis, which is effectively just understanding what's happening above and below spot price. And then we're looking for that confirmation in SPXA as well. So all that to say, we're in a bearish market. We're going to get to examples in a moment, but bearish market, we then start to see calls start to come in or puts start to leave on the SPXP complex. We want to see that manifest in the SPXA complex as well. I'm recording this video on April 26, 2025, so we'll just use some recent examples just to run through so you can just understand how to use this actually in your trading, not just, keep this theoretical because that's really not useful for anybody. So here on April 17th, 2025, this was just a put-dominated market. This is SPXA. This is your cruise ship. There's open interest of 14 million. Just keep that number in mind so you can compare that to SPXP in a minute. You can see the size. But there's not a ton to say here other than I've highlighted in the red boxes the key components of the structure we look at. And this is our web app dashboard. It's just a visualization of the option structure, SPXP again. Next, moving on to the SPXP, again, we can see that this structure too is call dominated above and below spot price. One thing to note though, that's different from the SPXA structures. If we look at the net OI column, which is just the distribution of calls and puts, open contracts within the structure, we can see that there is a bit more green, which is call dominated strikes than we do with red strikes. And again, if we just go look at SPXA again, we don't see that anywhere. We see a lot more red than green. And so what this tells us is that there is some call speculation happening in the structure. However, what we see is in the net delta column, which is effectively the net OI column, then we apply the delta at those strikes and options, which tells us that the delta of the in the money puts, which is closer to 1 than 0, still outweighs the deltas when applied to the calls, which those are out of money calls. So that delta is going to be, from 0.5 to 0. So again, that tells us there needs to be a lot more calls in the structure than puts to get that delta call dominated relative to put dominated. And just keep in mind, in a bullish structure that has a bullish foundation, healthy, it's call dominated, and we see all these strikes green. So it is possible, and we see it all the time in healthy markets. Just April 17, 2025 was not a healthy market. And again, as part of our market turning framework, because we're just talking about it right now, like we want to talk about our market trend model too, because it's a key component of that and something that we focus every day on heavily. And so and again, that's just built off the tick index. You can go to our curated playlist in YouTube, and you can watch the video on the market turning framework, on the market trend model, all that good stuff. Or reading the newsletter, we're gonna have links to the market turning framework there. But anyways, again, and during this time period, we could just see that the market trend model was trending lower as well. So again, we just have a lot of confluence between SPXA, SPXP market trend model that the market was not very constructive at this point in time. Now this brings us to April 25th, 2025. Again, going through the same process, looking at SPXA. First off, we can see below spot price, green dominated strikes. That's good to see. Above spot price, we have a mixture of in the money puts, out of the money calls. So all that to say, a mix of call and put dominated strikes, which again, when comparing it to this structure from a week ago at that point in time, that is a vast improvement. So again, you should be able to now understand, kind of looking at that day over day, week over week change in the structure and how we can do that through the web app dashboard and see that the structure is improving. And then moving to SPXP, again, we can see that the structure, a lot of green everywhere, very good to see, call dominated structures. So you can also see how the SPXP is, materially kind of more constructive than the SPXA structure, but both have been moving in the right direction. And then lastly, looking at the market trend model, again, we can see that this has also constructively turned higher, made the low on the 21st or, whatever date that is, and we have been trending higher since then. So again, we're getting confluence through kind of the key tools and pillars that we're looking at. Market trend model, again, remember shifts first, and we see that manifest through SPXP, SPXA. And that's what I just talked about just a second ago, just going to the market turning points, which is, a sequential process, starts with the market trend model, improves first, then we see SPXP, then SPXA. And right, that really just highlights that this progression from momentum, the short-term repositioning, to institutions confirmation offers the highest probability setup for sustained market terms, which we've effectively just outlined for you going through the two specific dates above. And the other thing to know is, we do have some other supplemental tools as part of our market turning framework that we want to see that helps us kind of understand under the hood what's happening with speculation. Again, YouTube video, this article we're going to link here. You can go read all about that. But you're not missing a ton of information. The web app dashboard and the market trend model do a great job of capturing that. So then, right, and then lastly, just implementing this analysis into your kind of daily market routine. Hopefully this doesn't come across as complicated. Like, most people in the community honestly just need to quickly glance at it and they kind of understand what the positioning on the day is. But right, first off, checking SPX structure, seeing if there's kind of a new change, day over day change, or just a continuation of the status quo. Then you go to SPXA, kind of see if it's telling you the same story or not. And then something that we don't get into explicitly in this article, but then looking at the transition zones within those structures. And those transition zones, if you're not familiar with it, you can simply just think of those as the transition zone as congestion in the option structure, where there's the battle between the call and put speculators. Breaking above the transition zone of the top side, call dominated environment, expect price action higher. Below the transition zone is bearish environment where puts are in control. And ideally, the best structures have confluence of the transition zones between SPXA, SPXP. So right, the whole idea there is you have a call dominant environment, price moves through and above the top of the transition zone, market trend model trending higher. That is a bullish environment, then vice versa to the downside. So right, then just bring in the article home. Next time that you're analyzing the markets, would encourage you not just to look at the generic SPX data. Consider separating the SPXA to SPXP because of the different stories that they tell that we just spent this time going through. And then last point, we don't know a lot of other people that are looking at the market this way. Maybe some are, maybe some aren't. We just know how we do it, and it is very beneficial to be doing this. So hopefully, if you were not familiar with this before you watch this video, you are now kind of enlightened and understand why it may be useful. And then lastly, hopefully, we went through actionable examples, so you at least have a takeaway of how you can implement this in your trading. Right, and this isn't meant to replace anything. If anything, it's kind of just a companion or just another tool in your toolkit. So with that, I appreciate your time. Again, in the description of the video, we have a link to our curated playlist in YouTube where we have a lot of these kind of educational videos going over key tools and how you can use that for kind of actionable trading knowledge. So with that, you guys have a good rest of your day. Thanks. Bye.